Iro okpai pa nake gani, amma iro okpai.
That's it.
Wisdom. Can you hear me? Hello?
Hello, ma. Good morning, ma.
Hey, good morning. Are we waiting for EC?
They just told me that EC will be joining, so we're waiting for him.
Okay, it's okay.
Yes, ma'am. Yes, ma'am.
Hello, hello, Aja. We are already on.
We are waiting for EC to join so that we can start.
Now stand by, okay.
Yeah, okay.
I hope it won't take time before he joins you.
Now, Wisdom, can you hear me?
Yeah, good morning, ladies and gentlemen. My name is Olufemi Olarinde, and we'll be commencing our webinar at this time. So, like in our usual way, the webinar is going to be taking a presentation. It will be from technical speakers. We're going to be having a welcome address and opening remarks from our chief host. And before we call on our chief host, we'll be calling on the person who has called us together today, who we call the landlord, and speaks to the taxpayers to come and usher in our chief host, the executive chairman of the Federal Inland Revenue Service. So I'll call on anchoring with me also is Mr. Wisdom Oshadari, who is here, Dr. Wisdom Oshadari, my apologies, and who is here to start, who will be starting this. So I'll call on Madam Angie Ayero to first tell us why we are here before ushering on in the executive chairman. Thank you. Madam, you have the floor.
The executive chairman, Federal Inland Revenue Service, coordinating directors of the service, directors and head of functions, colleagues, our esteemed taxpayers, ladies and gentlemen. I welcome you all to this taxpayer engagement webinar series titled Understanding the New Changes in the Finance Act 2023. Over the years, the Finance Act has been introduced to amend relevant tax laws, exercise and duties in accordance with macroeconomic policy reforms of the federal government, and also to amend or make further provisions and clarification in specific laws in connection with the public financial management of the Federation. The Federal Inland Revenue Service, under the leadership of the Executive Chairman, FIRS, Muhammad Nami, operates with 4 cardinal objectives, one of which is to position the service to be a customer-centric institution. Central to achieving this cardinal objective is continuous taxpayer engagement and enlightenment through various channels such as the webinar series we are holding today. The Finance Act 2023 has made new provisions and amendments to the Capital Gains Tax, Company Income Tax, Personal Income Tax Act, and the Tertiary Education Trust Fund. In today's webinar, we have speakers who are experienced tax professionals and administrators. They will be discussing the key areas of amendments and new provision into the Finance Act 2023. I welcome you all once more, and I wish everyone a successful deliberation through the duration of this webinar. May I, at this junction, humbly invite the Executive Chairman, Federal Inland Revenue Service, the Chairman Joint Tax Board, the Chief Host of this webinar, Muhammad Nami, for his opening remarks. You are welcome, sir.
Okay, good morning, distinguished taxpayers, my colleagues from the Federal Inland Revenue Service, the coordinating directors, directors of the service, and particularly Director Taxpayer Service, our host for this event. Let me use this opportunity to welcome all of us to this webinar in which we intend to discuss a document that is already in the public place with tax consultants, taxpayers, and other critical stakeholders, so that we will get to have feedback and comment from then on the provisions that were amended by the Finance Act, which ordinarily should have been Finance Act for 2022, but for Mr. President, former President, inability to sign the initial one that was passed into law in December 2022, which was eventually returned for some concern and returned to National Assembly for certain amendment, and was finally ready for a signature on 26th, and he signed on the 28th of May 2023, meaning that the Finance Act that ordinarily should have been Finance Act for 2022 is now Finance Act 2023. Distinguished board members on call, taxpayers, consultants, and colleagues, I use this opportunity to welcome all of you to this webinar so that we are able to discuss changes in tax laws. And I will enjoy all of us to feel free to ask questions where necessary, so that together we'll provide solutions to those questions. Distinguished ladies and gentlemen, it's my pleasure to now declare this process open so that we all share our views on the 2023 Finance Act signed into law on the 28th of May 2023 by the then President, President Muhammadu Buhari. Once again, you're welcome.
Thank you very much, Executive Chairman of the Federal Inland Revenue Service, Mr. Mohammed Nami. Thank you for those words. Our distinguished listeners have heard from the Director of Taxpayer Service, and you've heard from the Executive Chairman. The Finance Act has become a yearly ritual that all of us have to understand. Some have give their concerns, but what's most important is for us to understand it, so that at the end of the day, both the tax administrators and the taxpayers will be on the same page. And that is why we bring to you this webinar, to ensure that everyone has a common understanding. And where it seems that we do not, we need to discuss it. And to that extent, we'll be calling our speakers who we have prepared for today. We have with us Mr. Gabriel Ogunjemilisi, who will be speaking to us on those changes that concerns the Petroleum Profit Tax Act. We have Mr. Iro Okpai, who will be speaking to us on changes concerning the Capital Gains Tax Act. We have Mr. Kehinde Kajeshomo, who will also be speaking to us for changes concerning the Companies Income Tax Act. And we have Mr. Matthew Osaneku, who will be giving us an overview of the entire act. And by the time we finish with this, we are going to be having sessions for question and answer, and we intend to make it more interactive today through giving opportunity for live questions, more live questions, so that we can all discuss, interact before we commence the implementation of this law. And once more, I would like to call on Dr. Wisdom Moshadari, who will be calling in our speakers to start. Thank you very much. Dr. Moshadari, you have the floor.
Thank you, Femi Olarinde. Once more again, I want to welcome the ECFRS, all these coordinating directors, the directors, and our esteemed taxpayers, the participants. There's no doubt that the focus of Finance Act 2023 has the 5 major focus, which is tax equity reforms, climate change, green growth, job creation and economic growth, reforming tax incentives, and of course, revenue generation and tax administration. So without much ado with that introduction, I want to have the privilege to call the first speaker today, Mr. Matthew Osaneku. Mr. Matthew, I hope you are ready for us to have the overview of the Finance Act 2023. Mr. Matthew, you can come on board, please. Thank you.
Yeah, thank you very much, Mr. Wisdom. Can you hear me very clearly over there? Are you sharing my screen, or I should share my screen from here?
Okay, let me see if I can share for you.
Can you see my screen?
Okay, go ahead, please. Yeah, we can.
All right. Thank you very much. Dear listeners, Executive Chairman, ladies and gentlemen, we'll be quickly looking at the review of Finance Act 2023, and I'll be taking through this outline: culturalization of the yearly Finance Act, objective of Finance Act, the journey so far, Finance Act policy direction, few transitional issues and effective date, and relevant amendments of the tax law. Now, the concept of Finance Act. The Finance Act is a fiscal document initiated by the Federal Ministry of Finance, Budget and National Planning, and is prepared along with the annual national budget in order to facilitate a quick and focused amendment of various fiscal legislation for effective and efficient operation of yearly budget, and also to address other fiscal policy reforms. The concept has been on, and the process is well established, where we collect inputs from stakeholders and FRS, and this is coordinated by a committee set up by the Minister of Finance. It is called the Fiscal Policy Reform Committee. Now, key objectives of Finance Act are as follows. One is to raise revenue for the government to ensure that we close the gap, the close funding gaps, and also to reduce the debt ratio to GDP. Now, also to promote fiscal equity, reforming domestic tax laws to align with international best practices, because there have been a lot of development in the global space. So there's need for a tax law to align with what is currently going on globally. Implementing the recommendation of national tax policy. The national tax policy is a document that outlined a lot of reforms to the tax system. And via the Finance Act, we've been implementing all the recommendations. So let me quickly mention just a few of the recommendations of the national tax policy. For us to move from direct to indirect tax, that is ongoing. For us to begin to have a dual phased reduction of our tax expenditure, adoption of technology. So those are recommendations from national tax policy, and with the Finance Act, that is ongoing. Also, simplification of complex and ambiguous provisions of the tax laws. The Finance Act addressed all that. Blocking of loopholes in the tax legislation. Also to abrogate obsolete provisions of the tax laws to align with current realities. Because some of our tax laws have been moribund, and there is need for us to delete and update those provisions to align with the current realities. And also the Finance Act also addresses other economic and fiscal policy reforms that is initiated and coordinated by the Federal Ministry of Finance, Budget and National Planning. Now, the journey so far. Now, you agree with me that the last amendment to our law prior to Finance Act 2019 was in 2011, where PIT, Personal Income Tax Act, was amended. Our tax laws have been moribund and does not align with current realities. And we have numerous ambiguities in the various sections of the law that need to be amended. And this complexity in the tax laws has actually reduced our compliance ratio and also ultimately reduced our tax revenue. So Finance Act 2019 came on board and amended 6 tax laws, 1 non-tax law, and total sections amended, about 56 sections were amended. Finance Act 2020 also came on board and amended 6 tax laws, 10 non-tax laws, and total of 80 sections were also amended. Finance Act 2021 also was enacted, and 6 tax laws was amended, 7 non-tax laws, and we have about 41 sections of the law were also amended. Now, let's quickly go straight to the Finance Act 2023. Now, prior to the enactment of any Finance Act each year, the Minister of Finance, Budget and Financial Planning will roll out a policy direction. The tax system is anchored on 3 tripods: tax policy, tax law, and tax administration. So before any Finance Act is amended, is enacted, the Minister of Finance, Budget and National Planning will roll out policy direction. And the policy direction that was rolled out in December 2022, that was approved by the Federal Executive Council, highlighted 5 thematic areas for consideration. And these are tax equity reform. This was to combat tax evasion and aggressive tax planning. Climate change and green growth provisions. These will actually complement fiscal reforms that is designed to reduce greenhouse emission and climate change adaptation. Job creation and economic growth reforms. This is actually designed to complement the ease of doing business in Nigeria and to foster economic business environment for private sector for economic growth and development. Reforming tax incentive, which is the next one, is for us to implement what was rolled out in what was recommended in national tax policy, that a gradual phase out of tax incentive to reduce our tax expenditure. The last figure that was rolled out last year, that our tax expenditure stood at about 1.8 trillion. So there is need for us to gradually, consciously roll out this tax incentive. And also because of the evolving new rules that is being adopted globally. The next thematic area is generating revenue and tax administration. This is to raise revenue to the federal government in order to reduce borrowing and also improve the debt to GDP ratio, and also align with the Addis Ababa Declaration that taxation is the only sustainable source of revenue. Now, let's quickly look at some of the transitional issues. The FRS, when the Finance Act was enacted, quickly issue a public notice to address some transitional issues and effective dates. For appointed agent for VAT collection, the public notice actually highlighted that transactions in month of June should be remitted on or before 14th of July. Also, VAT withheld and collected in subsequent months shall be remitted to FRS not later than 14th day of the month following that in which the VAT was withheld. My colleague will be speaking to all the tax implication on all this stuff. I'm just highlighting the effective dates as clarified by FRS because of the transitional issue. Now, for items that have been excluded from building, the public notice highlighted that all companies letting out trading of furnishing services in line with those items were excluded must charge VAT at the prevailing rate with effect from 1st of July 2023. And also the rate of education that was increased to 3%. The public also highlighted that the new TET rate shall take effect on TET becoming due in respect of accounting period ending on or before 1st of July 2023. Also, all those incentives that were deleted, the effective date is that those effective dates will become due in respect of accounting period ending on or after 1st of July 2023. Just to highlight the effective date because of the transitional issue. The Finance Act was enacted and was signed by law May 29th. So because we have some transitional issues, that's why we have to highlight all those dates for effective and convenient administration. Now, let's quickly roll down with all the key amendments before my colleagues begin to speak to all the tax implications. Now, the capital gain tax, section 3 was amended to include digital asset as part of chargeable asset. Section 5 introduced of claim of capital loss against capital gains. Section 31 included stocks and shares are classified for the purpose of rollover relief. Let's quickly look at CIT. Now, Section 14 also introduced a provision that requires the service to request for evidence of filing of tax returns and PPT from shipping and online companies. Now, Section 32, 34, 37 that speak to investment allowance, rural investment allowance, and income earned on convertible currency are now deleted. So this incentive is no longer claimable. Now, second schedule also introduced the midstream gas operation to enjoy no restriction for the purpose of capital allowance. Now, PIT, Section 33 was amended, and the deferred annuity is now deductible. Now, for the petroleum profit tax, Section 2 included a provision and interpretation of the commission, the NUPRC, and defined the commission to replace NMPC. Section 10 of PPTA also introduced rules for the commissioning and abandonment. So when the speaker on PPT will be speaking to the tax implication and going to the full details of this amendment. Section 23 also did provide the duties and functions of the commission, and one of them is to determine fiscal oil price. Section 30 introduced actual filing regime in PPT, and Section 53 also introduced new penalty regime for PPTA. Now, stamp duties. Stamp duty Section 18A was amended and introduced new sharing formula of electronic money transfer levy. So one of my colleagues will be speaking to that. Education tax also was amended. A new rate of EET was introduced. VAT was also amended. Section 7 introduced adjustment to artificial and fictitious transaction for VAT. Section 14 also introduced new date for remittance by appointed agents, what I've highlighted in the public notice. Section 16 of VAT Act also introduced new rules for taxable goods purchased online. Section 46 also introduced new definition for buildings. So these are the amended tax laws that in Act 2023 amended. So we have 7 tax laws that was amended, 4 non-tax laws, and a total about 30 sections was also amended. So my colleagues will be taking you through all the tax implications relating to this amendment. So that's what I have for you, ladies and gentlemen. Thank you, and God bless you. So over to you, Mr. Wisdom, for the rest of the program.
Thank you very much for that overview, Mr. Matthew. I have indeed done justice to this. We want to urge our participants to take note of their questions. At the appropriate time, we'll be given the opportunity to ask your questions. So just document them down. So we want to take the presentation. So without much ado, we're going to the next presentation. And I'll be calling on Ms. Barrister Iropai, is the Director, Technical Department, Federal Revenue Service. I will be talking to us on capital gain tax, value-added tax, and personal income tax. Barrister Iropai, I don't know if you are ready, you can share the screen with us. Thank you.
Thank you. Are you hearing me?
Yeah, loud and clear, sir. Go ahead, sir.
Okay. The Executive Chairman, sir, coordinating directors here present, my colleague directors, other heads of functions, and our distinguished taxpayers, as well as stakeholders, consultants, and tax experts. My task is made simple because I am to look at capital gain tax. And then capital gains, like the tax policy man have said, about 3 sections were affected by the amendment. The first being Section 3A, where the previous provisions clearly stated that CGT chargeable on option, debt, and incorporeal property are chargeable property generally. And the new provision come on board to say CGT now chargeable on option, debt, digital asset, and incorporeal property generally. The implication of this section is that Digital asset, that is the major difference between this one and the previous one. E.g., cryptocurrency is now a chargeable asset. So unlike the previous one where cryptocurrency was not chargeable, Section 3A now brought in cryptocurrency as a chargeable asset. Section 5, you can call it exclusion of losses. The previous provision under this Section 5 was that in the computation of chargeable gains under this Act, the amount of any loss which accrues to a person on a disposal of any asset shall not, underline the word, shall not be deductible from gains accruing to any person on the disposal of such assets. The new provision, not showing.
Sorry, sir, the slide seems to be blurred. Maybe you can help us check, sir.
But there's, I think the network issue, because it's still very clear here. Let me see that one.
Oh, okay. It's not clear here.
Okay, Wisdom, can we send to you?
All right, sir. You can, sir.
Let's send. Yes. Wisdom, you have it.
All right, sir.
Wisdom, have you seen it?
Yeah, I've seen it, sir. I'm trying to.
Okay.
You can go ahead, sir.
I'm not seeing it here. I am not seeing it here, but I can go ahead. If others are seeing it, no problem. I can use my other ones. I haven't seen it. Are you seeing it? No. If you send from here, would have made any difference? But I'm not able to share. Wisdom, we're only seeing your email. Open it now.
Okay, that's what I'm trying to. Are you seeing it, sir?
No?
Let me save it.
Could I help you now? Network.
So are you seeing it now?
No.
No,
Ask-
no, please.
No. Okay, thank you. Oh,
Yeah, it's clear now.
it's clear now. Okay. Yeah. So go back to number 5.
Okay, you can share now, sir.
Yeah.
Well, good.
All right, go ahead, sir.
Go to slide 4, I beg.
Okay.
Okay, thank you very, very much, my dear. So sorry. It's an usual network problem. We said the previous position for section 5, exclusion of losses, this said that in the computation of chargeable gains under this act, any loss which accrues to a person on the disposal of any asset deductible from gains accruing to any person on the disposal shall not be deductible. And the new provision said, in computation of a chargeable gains under this act, the amount of any loss which accrues to the disposal of any asset shall be deductible from gains accruing to the person disposing that asset, provided that such loss shall only be deductible against the same type of asset. Next, where the aggregate capital, are you okay?
Yeah, go ahead, sir.
Where the aggregate capital losses by any taxable person in a tax year exceed the aggregate chargeable gains, such loss may be carried forward for deduction from chargeable gains arising from the disposal of same type of asset in the following year, and so on, the following year and so on, provided that such losses shall only be carried forward for a maximum of 5 years, immediately succeeding the year in which the loss was incurred. The implication of this provision is that the provision now allows for losses on the chargeable asset to be deductible from gains from that asset in the determination of capital gain tax chargeable. Such losses, however, is statute bar to 5 years. It's statute bar to 5 years. Next. We now go to section 31 of CGT, 31 sub 6, replacement of business assets. Previous provision on that section, 6, subsection 6. The classes of assets that enjoy 1, land and building, plant and machinery, ships, aircraft, goodwill. The next provision, the new provision now said, the classes of assets that enjoy rollover relief are as follows. 1, land and building, plant and machinery, ships, aircraft, goodwill. There is now addition of a stock and shares. Stock and shares are now been added to it. The previous provision did not include stock and shares. Now this one includes stock and shares. Next line. The implication of this is that stocks and shares are now recognized as class of assets that can enjoy rollover relief, meaning that the gain exempted from capital gain tax as a result of reinvestment within the same year of assessment will be taxed upon eventual disposal. Next. We now enter value-added tax. Like Matthew have already highlighted, some sections of the value-added tax were also amended by Finance Act 2023. Next line. Section 7, tax administration of the tax. Previous provision ended in subsection 2. New provision, sub 3, where the service is of the opinion that any disposition is not in fact given effect to or at any transaction which reduces or would reduce the amount of any tax payable is artificial or fictitious in nature. It may disregard any such disposition or direct that such adjustment shall be made as respect liability to tax as it considers appropriate, so as to counteract the reduction of liability to tax affected or reduction which would otherwise be affected by the transaction, and any company concerned shall be accessible accordingly. Go ahead. Next line. Next. For the purpose of this disposition, includes any trust, grant, covenant, scheme, agreement, or arrangement, or be transaction between persons, one of whom either has control over the other. The case of individuals are related to each other. Are you okay? Wisdom, are you following?
Yes, sir. Go ahead, sir. Slide 10, right? Oh, you are true.
No. Are you following? I was no longer hearing you.
No, we are together, sir. Go ahead.
Okay.
Yes, sir.
So we'll get back to the transaction between persons, one of whom either has control over the other, the case of individuals who are related to each other, or between persons, both of whom are controlled by some other person, shall be deemed to be artificial or fictitious if the opinion of the service or other relevant tax authority, those transactions have not been made on terms which might fairly have been expected to have been made by persons engaged in the same or similar activity dealing with one another at arm's length. That means that if we realize and consider that those transactions between connected parties or one person, company that are controlled by the same person, what we would ordinarily call in our tax parlance father and son. And then once that is determined, it's assumed that the transaction will not done at arm's length, and this we should disregard them. Next one, wisdom.
Yes, sir, I'm there.
Okay, a taxpayer in respect of which any direction is made under this section shall have a right of appeal in like manner as though such directive were an assessment. Just like when we issue assessment to taxpayer and they are not comfortable with it, they have a right to object. A taxpayer in this respect will assume that disposition, that our amendment to be an assessment and has a right of appeal to either tax appeal tribunal or the Federal High Court. Implication, this is an anti-avoidance provision which was hitherto not provided for in the VAT Act. Is a new anti-avoidance provision. Therefore, any disposition or arrangement for the avoidance of VAT will be disregarded and the VAT charge and charged accordingly. You know, while we had this in CETA, it's not the VAT in VAT. Next one. Section 14, collection of tax by a taxable person. Previous provision. The service may appoint any person to withhold or collect the tax, and the persons who are appointed shall, on or before the 21st day or the following month, remit the tax so withheld or collected to the service in the currency of the transaction. This was the previous provision. The Finance Act 2023 now said the service may appoint any person to withhold or collect a tax, and the person so appointed shall on or before the 14th day of the following month remit the tax so withheld or collected to the service in the currency of the transaction. So we look at it now changes from 21 days to 14 days. The implication: VAT agent appointed by virtue of Section 14 of the VAT Act are now to remit VAT withheld within 14 days of the subsequent month. This will allow for matching of input against corresponding output in the FRS tax solution. So it will now help us to match the input VAT with the current. Next slide. Okay, Section 16, remission of tax. Previous provision, which ended in subsection 2. The Finance Act 2023 made provision for a new provision of sub 3, which says where taxable goods imported into Nigeria were purchased through an online electronic or digital platform operated by a non-resident supplier that has been appointed as agent of the service for the collection of the tax. The importer shall, at the point of clearing such goods, provide proof of such registration or appointment and such other document as may be required by the service, and such shall not be further subjected to tax before clearing by the Nigerian Customs Service, pursuant to the necessary coordination on modalities between the service and the Nigerian Customs Service. Implication: this will remove possibilities of double taxation and strengthen VAT administration. So what it means that you are done with your business online by electronic, and then in the process of online, you are paid the VAT. So when the physical goods arrive the country at their border, the customs are not expected to charge you that again, because that will amount to double taxation. Next slide, Dr. Wisdom. Section 46, interpretation / definition of a building. Previous provision define building as any house, including any garage, dwelling, apartment, hospital, institutional building, factory, warehouse, theater, cinema store, milling building, and similarly roof structures of affording protection and theater, radio and television masts, transmission line, tower, vehicle, and other similar structures, but exclude mobile homes, caravan, and trailers. Caravan, and trailers. The section Finance Act 2023 now modified it a little to say building means any structure permanently affixed to land for all or most of the useful life of the structure, and shall include, without limiting the generality of the foregoing, a house, garage, dwelling, apartment, hospital, and institutional buildings, warehouse, theater, cinema, store, mill building, and similarly fixed structures affording protection and shelter, but exclude any fixture or structure that can easily be removed from such lands, such as radio and television masts, transmission lines, cell towers, vehicles, mobile homes, caravans, and trailers. The implication: this has brought to consumption tax the income from co-location services, that's like masts, transmission lines, mobile homes, etc., which were included as part of building before the current amendment and therefore exempted from VAT as land and building, and interest in land and building is excluded from goods and services. So before now, we know they were treated as part of land, and then they were not, the income and this thing were not subject to VAT. Now, by removing them, their interest and everything in is subject to VAT. Next slide. Dr. Wisdom, are we still there? Wisdom?
Yeah.
Hello? I've seen it now, but I want to be sure that they're all still clear.
Hello, sir. Are you hearing me,
Okay.
sir?
I can hear you clear now.
Okay, I'm hearing you, sir. Go ahead, sir.
Okay, so we are on personal income tax at Peter. Next slide. Dr. Wisdom, next slide.
All right, sir.
Okay, section tax personal leave. Previous provision before Finance Act 2023. It says they shall be allowed deduction of the annual amount of any premium paid by the individual during the year preceding the year of assessment to an insurance company in respect of insurance on his life or the life of his spouse, the life of the individual or that of the spouse. New provision, there shall be allowed deduction of the annual amount of any premium paid by the individual during the year preceding the year of assessment to an insurance company in respect of insurance on his life or the life of his spouse, or contract for a deferred annuity on his life or the life of his spouse. So the new addition is contract for a deferred annuity on his life or the life of his spouse. The implication, the provision expanded the subsection by reintroducing. This provision was here. I think it was in 2021 about that it was removed. By reintroducing deferred annuity on his own life or the life of his spouse. This again makes provision for premiums for both insurance contracts and or deferred annuity to be deductible for personal income tax purposes. So we thank all of you. I thank all of you for listening and for the breakdown in internet communication. I think we also apologize, but on this side, I was seeing it. I don't know it was not going around. I think it's maybe the unstable nature of my internet. So we will wait for question and answer sessions, or if it is taking place now, we're ready to take the question. So thank you all.
Thank you very much, sir, the Director Technical Federal Revenue Service, for doing justice to those topics. We still encourage our participants to take note of their questions at the appropriate time. You'll be given the opportunity to ask your question. So we'll go to the next presentation. And the next presenter is the Senior Special Assistant to the Executive Chairman FRS, Mr. Gabriel Ogunjemi-Lucy. He'll be taking us through Petroleum Profit Tax Act. Mr. Ogunjemi-Lucy, your answer.
Sorry, can you check your mail? I've sent it into you.
Okay, sir.
The paper. Confirm if you have seen it. Just a moment. I will try to first of all share it from here because I'm good.
All right, sir.
Then, okay.
So are you seeing it, sir?
Can you see my screen? Hello?
Hello, sir.
Can you see my screen?
Yes, yes, I can.
Okay. Just a moment. Come on.
Okay, sir. Clear.
Yeah, just a moment.
Very clear, sir. Go ahead, sir. Yes, sir.
No, I want to go back. I want to expand my position here. Where is it? Oh. Minimize this thing. No, the thing is not coming up. Sorry. Oh. It's not taking me back to the full page.
Okay, but I think it's clear here. I think
I can see that I'm not seeing the full page for my end.
Oh, okay, sir.
Take me back to full. What's this? Just a moment, I'm very sorry. Yeah.
No problem, sir. Take your time, sir.
Not because of the people. You take me back to the full page, okay? Sorry, I think I'm coming up. Okay. Anyway, it's not giving me this thing. Oh God. Oh shit. Yes. Hey. The thing is not coming up. Can you help me out? Yeah. It's not coming up, shared. Is there already? She already. Sorry.
Hello, sir.
So, thank you very much. I'm very sorry for the.
No problem, sir. Go ahead, sir.
Yeah, but she ended up bailing me out. Good morning, everybody, or afternoon. The Executive Chairman of the Federal Inland Revenue Service, the CDs, the directors, taxpayers, tax consultants, and other participants. The presentation that I have before me is that of understanding the amendment of the Petroleum Petroleum Profit Tax Act. The table of content is as given. We have introduction, then we have the saving provisions, conversion and godfathering provisions, amendment to the PPTA, and conclusion. Yeah, the question we have here is, but why do we still have the PPTA when there is the PIA? Should not all oil and gas producing companies be under PIA regime? That's a general question that may be bothering our mind, which we are going to find solution to. Then, savings provisions. The PIA saves some provisions of the, to the extent that those provisions will still be active till a certain period of time. One of the provisions, that was the act that was saved by the PIA is Petroleum Act, Petroleum Profit Tax Act, Deep Offshore and Inland Basin Production Sharing Contract Act, and any other laws or regulation consistent with the principles of Section 92 of the PIA. And the implication of this is that most of all these acts will still be in operation until certain time in the future, which it may be, some may be up to 20 years or less. Then there is another provisions in the PIA which talks about conversion and grandfathering provisions. The PIA gives companies, some companies, the voluntary conversion that they can voluntarily convert to the PIA if they so wish, but that one must be done within the 18 months after the effective date of the PIA. And by February this year, the 18 months has lapsed. And that means most of them, those who wanted to convert, will have converted by now. Then the law also gives conversion or renewal and relinquishment. This means that companies that do not want to convert voluntarily can wait to the time of renewal of their contract or when they relinquish the contract. Then there are some that the law specifically gave the compulsory conversion. And these are marginal feed operators. And this means that these ones, they don't have option, they must convert to PRA as soon as the 18 months expires. So a holder of an existing oil prospecting license or oil mining lease who did not enter into a conversion contract within 18 months from the effective date, or in the case of PSC that failed to complete the negotiation within the 12 months from effective date, shall continue on the existing law. That is, they can continue on the PPTA and deep offshore as the case may be. That is the reason why we are still having the PPTA, because some of the companies are still are yet to convert to the PIA regime, and therefore they need to be administered under the PPTA regime. In order to have uniformity in the administration of compliance rules and penalties, we needed to amend the PPTA, and that is the reason. That's why we have this amendment in place. Number one, Section 2 of the PPTA was introduced to introduce the commission, the NUPRC, which hitherto was not in the PPTA Act. Then we have Section 10 of the PPTA amended to give room for the liability of contribution for the commissioning and abandonment fund. Section 23 of the PPTA also was amended for replacements of posted price with fiscal price to be determined by the commission. Section 30, annual returns filing, that is the introduction of self-assessment, was also brought in. Section 51, penalties for offenses, and Section 52, penalty for making correct accounts. 53 also was amended for penalty for false statements. We are going to now look at them one after the other. Section 2, the introduction of Nigerian Upstream Petroleum Regulatory Commission. The commission established under the Petroleum Industry Act 2021 as the regulator of the upstream sector of the Nigeria oil and gas industry. That's that one alone. Section 10, that is of the PPTA. When by certain another section say called any amount contributed to a fund, scheme, or arrangement approved by the commission for the purpose of the commissioning and abandonment is now an allowable deduction once the company provides a statement of account of the fund as approved by the commission. In the old PPTA, contribution made for the commission and abandonment or any arrangement, if not expended, were not allowable deduction. And by now, once the fund is created and is approved, any contribution made to it will be an allowable deduction. Then the law also makes provision for after the commission and abandonment. If the amount, if you have surplus after the abandonment and the commission is restored, the surplus will be added back for tax purposes. If it's deficit, any additional expended amount will be an allowable deduction. Then Section 23, which has to do with the additional tax as a result of differential between the actual selling price and fiscal price. Replacement of posted price established by the company after agreement with the company with fiscal oil price determined by the commission. In the PPTA, before this amendment, and the methodology for determination of posted price is usually agreed between the government and the oil company, between the company and the government. But now the power resides with the commission to determine the fiscal oil price. But in doing so, the commission also need to consider the market prices in order to be fair and the prices to be used. Then determination of chargeable oil for domestic market now in the PPTA. Before this amendment, the chargeable oil price were only made for the exported crude oil. But now, in the view of the fact that there shall be local refineries where crude oil will be sold directly to them, the price need to be, the law need to be amended to take care of that situation. Section 30, that is the filing returns. Introduction of self-assessment regime. The amendment to the Finance Act 2023 brought in the self-assessment regime into PPTA. Before now, petroleum profit tax, companies in petroleum operations are not under self-assessment regime, but we have brought them in now that by the time they are filing their returns, they need to compute their self-assessment and support it with evidence of payment of the 13th installment. Then filing obligations for companies yet to commence petroleum operations. In the PPTA, there was a common gap in this one in this area because companies that are yet to commence operations were not considered in the old PPTA, but now they are recognized. They must file their returns 18 months from the date of incorporation in case of newly incorporated company and within 5 months after any period ending on 31st December of the following year in the case of any other company. Then there's a penalty imposed for for late filing. A penalty regime of 10 million naira on the first day the failure occurs, and 2 million naira for each and every subsequent day the failure continues has been provided for in the Finance Act. These also are what we have in the PIA. Section 51 of the PPTA is amended to read that the penalty for failing to comply with the provisions of the PPTA is liable to an administrative penalty of 10 million naira and further penalty of 2 million for each day the default continues, or such other sum as may be prescribed by the Minister of Finance. Another amendment is that anyone found guilty of an offense under the PPTA for which no other penalty is specifically provided will, upon conviction, be liable to a fine of 20 million naira or such other sum as may, by order, be prescribed by the Minister of Finance, or to imprisonment for 6 months, or to both fine and imprisonment. Section 52, introduction of administrative penalty. Of the higher of the sum of 15 million and 1% of the amount of tax uncharged for a person who makes up or causes to be made up any incorrect account by omitting or understating any profit or overstating any losses, prepares or causes to be prepared any correct schedules or statement by overstating any expenditures, royalties, or other sums, or by understating any amount repaid, refunded, waived, or released. Then another one, it gives or causes to be given any false or misleading information in relation to any matter or thing affecting its liability to tax. Any of this one will attract 15 million, the higher of the sum of 50 million naira, and 1% of the amount of tax undercharge. Section 52 also amended, in addition to the penalty for making correct account, I have the sum of 50 million and 1% of the amount of tax undercharge. The person will be liable for the appropriate tax which will have been charged. It's not only the penalty alone, the person will still be liable to pay the appropriate tax which he has not paid. 53, the last one said, any person who aids, abets, assists, cancels, incites, or induces any other person unlawfully to refuse or neglect to pay tax shall be liable to an administrative penalty of the highest of the sum of 15 million and 1% of the tax for which the person accessible is liable to under this act for the accounting period in respect of or during which the act or omission occurred, and shall, in addition, be liable for appropriate tax which will have been assessed or charged. Not the same thing like the other one, understatement or the declaration of income for tax purposes. So 53C continue. The person who does any of the acts or makes the omission contained in subsection 1 of this section commits an offense, and on conviction the person will be liable in addition to the appropriate tax which will have been assessed and charged, a fine of the IR of 15 million and 1% of the amount of tax for which the person accessible is liable, or to imprisonment for 6 months, or to both the fine and imprisonment. As I said earlier, all these that they are not new, they are already contained in the PIA sections. What we have done is just to bring them into PPTA, because the PPTA will still be operational until a certain period of time. Then in conclusion, the PPTA and the PIA fiscal provisions will concurrently coexist for at least the next 20 years due to the saving provisions of the PIA. The alignment of the compliance provisions of the PPTA with some of the provisions of the PIA will ensure uniformity in the compliance rules and penalties for both converted companies and unconverted ones. Thank you, and God bless.
Thank you very much, sir, for that presentation. As usual, we still encourage our participants to document their questions, and at the appropriate time, you'll be called upon to ask your question. We'll be going to the next presentation.
Let's bring this down.
So can you exit the...
That's what I'm trying to do now.
All right, sir.
This is my name. Take out post-its. And I pause now. Then another person can share.
Okay.
I still can't share. Click on stop sharing.
My something. Okay, stop share. Yeah. Okay. Sorry.
Right there now. Thank you, sir. We'll go to the final presentation. And I have the privilege to invite Mr. Gabriel, Mr. Kehinde Kajesomo. Mr. Kehinde Kajesomo is the Deputy Director and Head Treaties and International Tax Policy of Tax Policy and Advisory Department of Federal Inland Revenue Service. So he'll be talking to us on Company Income Tax Act. Mr. Kehinde, you have the floor, please. Thank you.
Thank you, Mr. Wisdom. It is a privilege to be here this afternoon. Good afternoon, the Executive Chairman, Federal Inland Revenue Service, the coordinating directors, the directors, our other colleagues, and distinguished taxpayers, tax consultants, and everyone on the call. My name is Kehinde Kajesomo, and I will be speaking on the amendments to the Companies Income Tax Act, Cap C21 LFN 2004 as amended. In this Finance Act 2023, there were 8 amendments that relates to the Companies Income Tax Act. And the amendment is spread over 3 sections and 1 schedule. And I start with the first one. The first amendment is contained in section 14 of the Companies Income Tax Act. And we know that section 14 of that act relates to the taxation of companies engaged in shipping or air transport. The section was amended by introducing a new subsection 4A. And that subsection 4A provides that non-taxpayers shall file income tax returns containing a certified gross revenue statement of its Nigerian operations. We understand that under subsection 2 and 3, section 3 and 4 of the existing law, section 3 is about taxation, the rule for taxation, which require that the taxpayer is subject to tax using the adjusted profit ratio and the depreciation ratio. And in using that, one of the information that is required is the turnover or the revenue that is generated from Nigeria. So what the law, the new introduction or the new insertion into the law is saying now is that when you are filing your returns under that section, either for the purpose of the adjusted profit ratio and depreciation ratio, or for the purpose of the application of reasonable percentage under the next subsection, the taxpayer is expected to file his detailed gross revenue statements of his Nigerian operation. And that detailed information must show the full sums that is earned in Nigeria and must be supported by all invoices issued to their customers. And that statement must be certified by the company's external auditor and one of his directors. So that is the new requirement of section 14(4)(a) of the existing law. Then we have the section 14(c)(6). A new subsection 6 has also been introduced, which requires that any company in that sector that is engaged in shipping or air transport, that is foreign companies now, when they seek approval or permits relating to their operation, they must provide evidence of returns filing, evidence that they have filed their tax returns, and they must also provide TCC. And this is a prerequisite for them processing approvals and permits from any regulatory agencies. What this means is that NIMASA, Nigerian Civil Aviation Authority, probably FAN, and the Nigerian Port Authority, as many that provide form of approvals or permits to these airlines and shipping companies, they must request from those companies evidence that they have filed their income tax returns. And they must also request for tax clearance certificates that has been issued by the Federal Inland Revenue Service. Without the provision of such documents, they will not be entitled to those approvals or permits under this section or this subsection of the law. The next amendment is in section 32 of CETA, which is on reconstruction investment allowance. Prior to now, we have provision under section 32 that gives 10% investment allowance for 10% reconstruction investment allowance on qualifying plants and equipment. Now in Finance Act 2023, that section has been deleted. So that additional 10% in respect of qualifying plants and equipment no longer available. However, the question may be asked, what about those that have incurred and before they could claim, this law has come out providing for the deletion. The section that provides for the deletion clarify that for those that have incurred that expense or that qualifying plant and equipment expenditure, they will be allowed to claim in respect of that previous expenses that have been incurred. So those that have incurred that expense before the effective date of this law, they will be allowed to claim. But we shouldn't forget that it is claimable only once. So those that have incurred, they are allowed to claim it only once in the year of use. And if it cannot be claimed in the year of use, then it will lapse. We also have section 34, which is on rural investment allowance. That same section 34 has also been deleted through the Finance Act 2023. Section 34 is that law or section that provides for rural investment allowance for companies that have that are located or situated 200 kilometers away from 20 kilometers away from public electricity, public water, or tarred road, and have provided all this themselves. Then the law grants them allowance of 15% up to 100%, depending on the assets that have been provided. Now, I said this section has been deleted, but another question is, what about those that have incurred that expenses before the effective date of this Finance Act? The provision provided for that deletion allow them to claim for those that have incurred, not those that will incur subsequently, but those that have incurred have not claimed. The law allowed them to make that claim. I also need to clarify that this is also available only once in the year of use. Any company that is unable to claim it in the year of use, it also lapses. That is the provision of the law that have now been deleted. We have section 37, which is in respect of incomes in convertible currencies. That section 37 has also been deleted, but prior to this deletion, that section provide that 25% of incomes in convertible currencies derived from tourists by hotel is exempt from tax, provided that the income is placed in a reserve fund for expansion and it is utilized within 5 years. So now this provision has been repealed. But what happens to those that have complied with the previous conditions? That is, they have set out that income and they have put it in a reserve fund. What happens to them? This new amendment that provides for deletion allows them, for those that have provided those funds in that reserve fund, they will be allowed or they will enjoy that exemption until the money they have provided is fully utilized. But we shouldn't forget, it says it must be utilized within 5 years. So if they are unable to utilize it within that 5 years, it will also lapse under the existing rule. So those that are provided, they are allowed to utilize it and they will enjoy the exemption for 5 years. But if, for instance, they have utilized it for 2 years, we have only 3 years left. It's only 3 years that is left that they will allow to claim the exemption. We also have amendment to the second schedule of the second schedule of CETA, which is on capital allowances. There's amendment under section 18. Section 18 is paragraph 18 of second schedule. Paragraph 18 is the paragraph that deals with leases on the books of claims of allowance by lessee. And in that section, in that paragraph, so paragraph 3, provide for investment allowance in respect of capital expenditure on plant and machinery, while subparagraph 7 provide for investment allowance in respect of capital expenditure on agricultural plants and equipment. In order to align this provision with section 32 that have been deleted, these 3 subparagraphs has also been deleted. So it is not only the investment allowance under section 32 that is deleted, all the relevant provision also in subparagraph 3 and 7 of paragraph 18 has also been deleted. So that 10% investment allowance will no longer be available for claim. Then we have amendment to the second schedule of of CETA, which is paragraph 24. And this paragraph introduced unrestricted capital allowance for capital expenditure used for upstream and midstream gas operations. Prior to now, we have that paragraph 7, subparagraph 7 of paragraph 22 that restricts capital allowance to 66 2/3. Capital allowance under that subparagraph is restricted to 62 2/3. But some special industry or some companies engaged in some industry, theirs are not restricted. And those industry then were agro-allied industry and manufacturing, those engaged in agro-allied industry and those engaged in the business of manufacturing. Now, 2 other industries has been added, which is those engaged in upstream and those engaged in midstream gas operation. So what it means is that their capital allowance will not be restricted under subparagraph 7 of paragraph 24. And that is all for the Companies Income Tax Act amendment. Thank you.
Thank you so much, Mr. Kende, for that exposition on the Company Income Tax Act. I really appreciate that. So at this junction, we're going to question and answer section. Though our time is fast spent, we will not be able to take much questions. Before we give live questions to our participants, I will start with Mr. Urokbai, the Director of Technical. Sir, are you there, sir? Director of Technical, are you there, sir?
Yeah, I'm here.
Yeah, the first question goes to you, sir. Says, sir, can you explain how disposal of digital assets should be handled by multinationals, by MNEs without significant economic presence? How disposal of digital assets should be handled by MNEs without significant economic presence?
Okay, thank you very much. Disposal is disposal, excepting that one is done online and the other one is done physical. The online means that it can be done from, it can dispose from, while in America, through the internet or social media, human or whatever, you can sell their products. The rate and the law still applies, irrespective of the distance. What is important is that the asset to be disposed is owned by the other party, the other one is willing to buy, and then they struck a deal. The digitalization is only a means of payment, so whereby you can pay without necessarily physically going to the bank. You can use any of the payment instruments and pay. So it can still be handled by both parties by the using technology to make it. It's introduction of technology that changes it by calling it the digital process. Instead of manual, it is now automated. And the law does not change. The law does not make any rule, any exemption for digital or physical. What is important that an asset has been sold, again have been made, and the rate to be applied will be applied, irrespective of the distance. And then is the asset located in Nigeria and is subject to capital gains in Nigeria? Yes. If it's not, no. So technology makes it simple, easier, prevent fraud, and then make the transaction seamless for both sides. So both the seller and the buyer, and even the government that is going to get the tax, it will make it very simple and easy for them to implement.
Thank you very much, sir. And we still have more questions because most of the questions are on VAT, sir. Somebody want to know about self-charge and reverse charge. They want us to throw more light on it, sir.
Yeah, that's what we talked about. If you go to section 14, you know, when you talk about self-charge and reverse charge, where now you have appointed agents, tax agent to collect your VAT. And those agents, it means we are simply saying when somebody makes a transaction with you, collect the VAT, and then you remit on his behalf to government. So you are saying that for every transaction, and that's like when they will have in sectors like oil and gas, MDAs, and now we have added the banks and added the MTN, Econet, and all that. They are the ones that will help us as agents to collect the tax, charge their customers, and remit the money to us.
Thank you, sir. There's another question on the new deadline of filing of VAT, which is 14th of the following month of transaction. Is it applicable for only those empowered to withhold VAT, or is general?
It's only for those appointed, those agents, and it's not general. The general, the 21 days still remain.
Okay, all right, sir. Thank you very much, sir, for your responses to those questions. I will go to Mr. Matthew. Mr. Matthew? Mr. Matthew, are you there, sir? Mr. Matthew?
Can hear you. Can you hear me?
All right, yeah, loud and clear. This question goes to you. I say, can you explain how disposal of digital assets should be handled? Okay, no, this is not for you. Okay, sorry. I understand one of the focus areas of the changes introduced by the Finance Act in 2023 is the climate change green growth. Say somebody said he wants to know, you want to appreciate if you can throw more light on it. What are those provisions that has to do with climate change or green growth?
Yeah, like I said earlier, the minister, in her wisdom, roll out 5 thematic areas for consideration. So one of such consideration is to actually provide some tax provision that will address climate change and green energy growth. And one of such provisions that was actually rolled out was to introduce higher tax rate for gas flaring and new tax regime that would deter companies that is flaring gas, and also provisions that will actually affect greenhouse emission and climate change. Those provisions did not scale through, but when those thematic areas were rolled out, those provisions were actually developed, was submitted to National Assembly, but didn't scale through to be approved or to be ascended to by Mr. President. So basically, that provision actually seeks to complement fiscal reform, designed to reduce greenhouse emission, and also this climate change adaptation, to ensure that strict penalties are applied to companies that flare gas, and new regime that will actually encourage us to begin to look inwards and do backward integration to ensure that we use our gases for growth and development. Thank you very much.
Thank you very much, sir. Mr. Kinde, I don't know if you are there, sir. Mr. Kinde, Kajisoma, are you there, sir?
I am here, Mr. Wisdom.
All right,
Yes.
sir. This one goes to you, sir. Given the difference between the date the act was signed and when it became effective, is it a retroactive law, or what are the implications to tax stakeholders?
Thank you, Mr. Wisdom. It is not a retroactive law, because if you look at the section relating to commencement, it provides for May 1st, and it's also provide for the dates advised by the president. So there were alternatives provided there, and that form one of the basis why the service has issued out. That was one of the reasons why the service has issued out a public notice to provide for implementation, so that taxpayer is clear on how this will be implemented. And if you look at the public notice that have been provided, you see that the service provide for 1st July as returns filed from 1st July. That's the date provided in the public notice. And that is to take care of the fact that the act was the effective date clearly quoted was May 1st, and also the alternative date provided in the law, which says the dates advised by the president through signature. Thank you.
Thank you very much, sir. I still have one question for you, which is a very direct one. Should we charge VAT on AGO? What is the position of Finance Act on that?
Thank you for the question. This is not the question for the Finance Act, but the modification, the VAT modification order that was issued. And that VAT modification order exempts petroleum products. And it defines petroleum products that are exempted. And diesel is not one of those products that was exempted. So if you recollect that the VAT Act says the VAT is charged on all products and services that is not exempt in this schedule. So if diesel is not one of the product exempt in the schedule or in the modification order that's amending the schedule, then automatically diesel is one of the products that is chargeable to VAT. Thank you.
Thank you very much, sir, for the excellent responses to those questions. Because time is not our friend, we'll take some live questions from our participants. I can see a lot of hands are up. So now give opportunity for those that want to ask live questions. Mr. Aaron Aleonoye, are you there, please? Mr. Aaron, are you there?
Yeah.
Okay, please can go ahead and ask a question, please.
No, okay, I don't have any question right now to ask.
Okay, all right, your hands is up, so you can take that.
I did.
All right. Funke Ali, are you there? Funke, are you there? Mr. Tunde Meshoye. Mr. Tunde, are you there?
I'm here. Good afternoon.
Good afternoon. Go ahead, sir.
Okay. I don't know which director will be responding to this question. I'm an operator within the downstream sector of oil and gas. I said diesel majorly. But my question is this. Within the new Finance Act, I stand to be corrected that anyone running an SME with an annual turnover of 25 million naira will be exempted from paying tax. Am I correct?
Go ahead with your question, sir. We have people that
okay, my question is that within that industry, we have some people that run agency operation as marketers that earn very little amount of money in terms of commission, 10 kobo, 20 kobo. But because payment goes through their account, and if you assess them, people will think they have large turnover, but their margin is very, very small. For example, somebody can have a product source of, say, 40 million naira because of the high cost of diesel. But on that 40 million, maybe I just only 100K as his own commission. Now, when stars people comes, they look at the turnover and they begin to disturb them. Meanwhile, they are just small operators. So how do we assist people running in that sector? That's my question.
All right, sir. Thank you very much.
You are welcome.
Let's take more questions. Mohammed Awa, are you there? Mr. Daniel Olusheyi. Mr. Daniel. Gloria Enya. Mr. Imam Sani, are you there? Mr. Imam. Hannah. Madam Hannah, are you there? Akini Nola.
Good afternoon. Can you hear me?
Afternoon. Go ahead and ask your question, please.
Okay, so I have a question as regards VAT. I have some vendors that has refused to remit or upload my VAT. So at the point of filing my returns, I had to pay excess VAT. So going forward, can I deduct the VAT they've refused to upload from their pending payment, or how do I escalate them to FIRS?
Sorry, your question is not clear. Can you come again?
Okay. I paid to some suppliers.
Okay.
They've refused to upload it on their tax forms, as it's not showing as my own input that I used to reduce my tax on VAT payable. Hence, I had to pay more.
Okay.
So my question is, can I deduct the amount I have paid, or how do I escalate them to FIRS?
Okay. All right, we'll provide the answer to the question at the appropriate time. Mr. Kumar Panjak. Mr. Kumar, go ahead, please. Mr. Kumar.
Hello.
Yeah, go ahead with your question, please.
Yeah, good morning. Thank
morning.
you so much for the presentation and session.
Hello, go ahead with your question.
Yeah, I just wanted to request you that is it possible that for the entire session we can have the PDF and PPT?
All right, if you actually register with your email address, we'll send the presentation slides to you. Definitely.
Oh, good. Okay, thank you so much. For the session, we are registered. For the IFRS, I have not registered. So for session registration is okay?
Come again, sorry?
I said I have registered for the session. That's why I attended today. So is it okay, or I need to register separately?
I didn't get that.
For today's session, I have already done the registration.
Okay, you registered today?
Yes.
All right, no problem. We'll get the slides back there to you then.
Okay, okay. Thank you so much. Have a nice day.
You're welcome. Mr. Daniel, are you there? Daniel Olusheyi.
Sorry?
Mr. Daniel Olusheyi, are you there? Okay. Funke Ali, are you there?
Yes, good afternoon, sir.
Good afternoon. Go ahead with your question.
Okay, sir. I have a question that if I have a contractor.
Go ahead, please.
So, am I and the invoice to me with VAT? Am I supposed to withhold the VAT or pay the vendor the VAT? what am I supposed to do on the VAT on the invoice that's issued to me by a foreign contractor?
Okay. Your question again. Hello.
Sir.
Hello. Your line is breaking. Come again with your question, please.
Okay, sir. I said that I have a vendor, like a contractor, that is supposed to carry out a service for my company in Nigeria, but it's a foreign vendor. Okay. So if the vendor issue invoice to me with VAT on it, what's the implication? Am I supposed to withhold the VAT or pay the total amount VAT inclusive to the vendor? What's the VAT treatment on that invoice, as well as withholding tax?
Okay.
Yes. Thank you, sir.
Thank you.
Yes.
Those are the other people. Yeah, let me check here. Is Damilare there? Damilare Abdullahi.
Hello, good afternoon.
Okay, go ahead with your question, please.
Oh, all right. First of all, kudos to the FRS team for coming up with this sensitization. My question actually relates to the effective date for the Finance Act 2023. So my understanding is that the Finance Act itself indicates that the effective date is May 1st, 2023. However, I also saw it in the FRS and public notice that the Finance Act was actually enacted on the 28th of May. And so please, if you can just help to clarify, is the effective date 1st of May or 28th of May? Yeah, thank you.
Okay, thank you. Adebayo Shola. Adebayo Shola, are you there?
Hello.
Yes, go ahead with your question, please.
Okay, good afternoon. Sorry, I'm an operator within the real estate sectors in the country. There is this provisions in the Finance Act 2021 which exempts the real estate participants to be charging VAT from their customers. And I've had issues with the FRS staff in the past that says that the provisions was no longer, or there's an issues that in the applications of that provisions in my accounting. So could you please clarify that, if it still exists or not? Then secondly, is cryptocurrency now a legal business in Nigeria? Thank you.
Thank you very much. I think time is no longer a friend. We have a couple of questions. I think we should do justice to them. The first question is VAT suppliers refusing to upload the inputs. Can they deduct the amount? Mr. Ropai, please, are you there, sir?
Hello?
Yes, sir. I'm sure you are listening to some of those questions, and it borders on VAT, sir.
Just reject them. Let me hear.
I think somebody was asking if the VAT, the supplier refused to upload the inputs, to the tax promo solution. That can he or she deduct direct? I think it borders on the VAT inputs.
The if he's not, I'm sure he's talking about agencies and MDAs that he worked for,
yeah,
deducting and not remitting to FRS to enable him to take advantage. We have had similar situations in the past. The question is that, do we have the money enable us give to you? If we don't have the money, we are running at a loss. However, but he can, as a person, if he's sure that they will not cut him off from future supply, write the name of the agency or the establishment and write to FRS that he did contract with you. If you like, to make it easier, attach his invoice they issued to him, he issued to them the amount they paid to her or him to show that they didn't pay him full, and then probably his bank statement to show that this is actual amount to recover. And then we will go immediately by way of investigation or special crime, or even our police unit to pursue the guy to recover the money.
Right,
but some of them, if you tell them to report them, they will say they will not give them contract again.
Okay. All right, so I hope that is clear. There's another question on charging VAT by the real estate participants. People have been saying, okay, the law is there, it's not there. That people, the real estate participants, they be exempted from VAT. They're not supposed to charge VAT. So somebody want a clarification on that, sir. People that operate in the real estate sector. So what is the VAT status? He wants to know.
If they are specifically into land and building, they will not be subject to that. If they are doing other businesses, other services they are rendering to people, such services that does not fall under the definition of land and building will be subject to VAT. Like they receive commission, you are selling, you're into real estate, you are selling, and then you are paid commission. There's both the agency and commission and even other fees that are attached to it. Those commissions are subject to VAT. But if it's the typical one on land and building, they are not subject to VAT.
Finally, sir, on the cryptocurrency, at the new Finance Act 2023, said they'll be charging digital assets, including cryptocurrency, at the rate of 10%. Somebody was asking, cryptocurrency is not legal in Nigeria. So what can you say about that, sir?
Cryptocurrency, so to say, you can't say it's legal in Nigeria. CBN does not recognize them as a pure banking something to operate, but individually they are still doing it. And that's why the government considered it wise to avoid leakages, to charge them for that, introduce tax on them so that capital gain tax on them so that they will not be making billions and trillions and going away with it. But as a formal banking service, the CBN, because why? If you ask the CBN, they will tell you that they don't want to take liability on the because the moment they accept them, they will be responsible for all their acts. And again, CBN will also tell you that they are not registered with them. So if you are not under their control 100% and they are not monitoring you there, they don't want to take that liability of cryptocurrency. But cryptocurrency business is going on in Nigeria. It's not, the federal government have not declared it illegal because people are doing cryptocurrency. And that's why the 2023 Finance Act now went ahead to take it. So it is not that CBN does not recognize it and doesn't make it illegal because the business is ongoing.
All right, thank you very much, sir, for a wonderful response. Mr. Kainde Kajesoma, are you there? Mr. Kainde, are you there? All right. Sir, can you just throw more light on the effective date of Finance Act 2023? Okay. Some different views on the effective dates. So we want you to clarify on that, sir.
Okay. So let me read from the law. Section 30 of the Finance Act says, the provision of this act shall take effect from 1st May 2023, or such other dates that shall be indicated by the National Assembly by law or by the President of the Federal Republic of Nigeria by assent. So, number one is, it says effective date, effect from 1st May 2023. but it also say, or the date that shall be indicated by the president or the Federal Republic of Nigeria by assent. So the president assented to this bill on May 28th. So is May 1st or May 23. So I mean May 1st or May 28th, which is the date in the, it was assented to by the president. So since the date assented to by the president is May 28th, my understanding is that it should be May 28th because we have two alternatives there.
All right, thank you very much, Mr. Kende. Our time is not our friend at all. We want to thank all our speakers for a job well done. We want to also appreciate our esteemed taxpayer, the critical stakeholder, for finding out how to join.
I'm sorry, there's one question you're meeting. Somebody contracted by a foreign contractor.
Oh, yes, sir. Yes, sir. So it's like you got the question. Can you respond to that, sir? Sorry, that was an omission.
Okay, just a very quick one. If the foreign supplier is not known to us by way or not registered to us as either a non-resident or a taxpayer, the person that received the goods, the supply is made, is expected to deduct the money by way of self-charge and remit to us. But the other one is not known, is not in a net, is not in a book.
Thank you very much, sir, for that response. We want to appreciate everyone who has taken time to join us this afternoon. Our job is to educate, inform, and engage the taxpayers to enable them perform their tax obligations. As we all know, there is no ignorance in law. So our job is to ensure the taxpayers are properly empowered, to enable them know their rights and obligations as well. So we want to really appreciate you. The time is no longer our friends, but most of those questions that were sent in, we're going to provide responses to them through your email addresses as time permits. And the slides, those that are requested for the slides, we're also going to send the slides through your email addresses. We want to really appreciate you. This will be a continuous process. And as time goes on, we hope when we call upon you, you also find time to be with us. We have in our midst the Coordinating Director, Compliance Support Group, Mr. Matthew Budibola. We invite him to make his remarks and at the same time, give us a closing part. Mr. Matthew Budibola, the Coordinating Director, Compliance Support Group. You're welcome, sir.
Okay, thank you very much, Wisdom, and thanks colleagues who have been talking all the while explaining the new Finance Act. And thank all our taxpayers and colleagues out there for making it up to this event. We sincerely hope that we have been able to provide you with explanations as to the effects of the relevant provisions in the Finance Act. And I do hope that we will continue to have this engagement so that we have clarity around the rules, and also we are able to drive voluntary compliance. And so I say thank you to everyone. And if there are issues that are still unclear, we please request that you get in touch with us. You can get directly to the Tax Policy Department, or you can come through the contact center or through the Taxpayer Service Department. Whichever way you choose, we assure you that we will promptly attend to whatever issues that you are bringing to us. I think at this junction, let me, on behalf of the Executive Chairman and the management of the FRS, say thank you and bring this event to a close. God bless you. Bye.
Thank you very much, sir, for that wonderful parting remarks. Thank you. See you the next time. God bless you all.